Building an investment portfolio is a lot like cooking. To get the best results, you want top quality ingredients in the right proportions. And if you don't have the time or expertise, there are professionals to help you achieve your goals. In the kitchen, you can turn to recipe books for help. In the investment world, you have the option of picking individual investments, like shares and bonds, and combining them yourself, or you can also have it done for you by buying a fund. What is a fund and how does it work? A fund pools together your money along with money from other investors and invests it on your behalf. You can pick an option to suit you based on the objectives of the fund, for example, investing for growth or for income, and where you want to be invested, for example, a fund which invests globally. Like ordering a pizza, you place an order knowing the chef's methods and the toppings you'd like. But you don't control the details, like exactly how many slices of mushrooms will be on top or how the tomato sauce is made. Funds offer instant diversification. Invest in just one fund and you have bought a whole basket of shares or bonds depending on the fund's goals. Changes in the value of the underlying investments and income those investments produce are then reflected in the value of the fund and the value of the portion you hold. If the value of one investment held within the fund goes down, other investments could stay the same or go up. This helps to smooth the ups and downs, offering less volatility compared to investing in only a handful of individual shares. Investments tend to outperform cash over the long term, so you should only invest if you won't need the cash for 5 years or longer. Unlike cash, investments can go down as well as up in value, so you could get back less than you put in. It can be expensive for you to buy all the ingredients of a diversified fund individually. Costs like dealing fees can eat into your returns. In a fund, these costs are shared with other investors. With funds, you've also got access to things that are hard to get your hands on directly. This could be shares listed on overseas markets, property, or commodities like oil or gold. This makes funds a great way to diversify your portfolio, especially if you only hold a handful of shares or you're starting out on your investment journey. How do I use funds to build a portfolio? A handful of funds are a great way to build the core of your investment portfolio. Then you can think about adding more specialised investments. Some funds will be more risky and prone to volatility than others. Funds with a higher weighting in shares or focus on a single area or industry are typically considered more risky. We all have different tastes, so make sure the fund matches your circumstances and appetite for risk. The types of funds available. There are two main types of fund you're likely to come across: passive and actively managed. Passive funds, also known as index tracking or tracker funds, aim to match the performance of a particular stock market. They can do this by investing in every share in the index being tracked. For example, a FTSE 100 tracker could hold shares in each of the companies listed on the FTSE 100. Passive funds that track an index can offer a convenient, low-cost way to gain exposure to the performance of a broad range of companies. In just one investment, you can effectively hold an entire stock market, becoming an investor in hundreds or even thousands of businesses. Trackers do exactly as their name suggests. They follow the market. They will include the best performers and the worst. On the other hand, in an actively managed fund, the fund manager will make changes to try to outperform the market, aiming to improve the returns that they deliver for you, although there's no guarantee an active fund manager will outperform the market all the time. How much do funds cost? Once your money is invested in a fund managers usually charge a fee as a percentage of the money you have invested with them. You can find out the specific charges on the fact sheets for each fund on our website. Actively managed funds tend to be more expensive than passive funds. This is because in actively managed funds, you're paying for the fund manager's research, analysis, and expertise in managing the investments. Whichever type you choose, there's also a charge to hold funds on an investment platform. With HL, this is not more than 0.45% of the value of your investments per year. With HL, you can start investing from as little as £100 lump sum or £25 a month. You can access funds with smaller regular contributions, helping to average out the highs and lows of the stock market. This takes the pressure off trying to time the market and can be less daunting than parting with a larger lump sum, though smaller investments can limit your returns if your investments do perform well. For more information on how to get started with investing, visit hl.co.uk/learn.